Hello, my name is Kaysie Adkins. I am the Family and Consumer Science Extension Agent for Sevier County. I want to welcome you to Day 4 of Sevier County Saves Week. I hope that you enjoyed today's presentation brought to you by Jonathan Johnson from Edward Jones Pigeon Forge. We are glad that you could join us on YouTube or wherever you get your podcasts. Without further ado, let's dive into investments with Jonathan Johnson.
Good deal. Well, yeah, thanks again to Kaysie for having me. It seems like you guys have had a good week filled with lots of sound and good topics, and I'm kind of coming in here on the back end and finishing up. So I have a tough act to follow from yesterday. I know Mark Robertson very well from Smart Bank, and he does great work. And so, but I'm kind of hoping to build off of everything that's been covered this week, and I'm talking about investing. What I do in my role is really what Edward Jones' model is, and that's making sense of investing. And investing is can be hard to understand sometimes. There's a lot of different, I'll say, avenues to it. And there's a lot of different mouthpieces to it out there. And it can be tough to understand sometimes. So that's what I hope to provide to local Sevier County residents and locals is in a sense of understanding when it comes to investing and how to build a foundation off of that, because you don't really, the first place to start with investing is one, and that's where I start people with is what is your monthly income at? And that's why I'm really glad the way that this schedule this week fell the way it did, is because I know you talked about saving and budgeting earlier in the week, and that's where you need to start before you even get to investing, because the number one most important thing is that you have money each month, number one, to live, but number two, for in case of emergency. And then from there on, that's where I kind of come in, and that's where we start saving and investing for another day. And but I'm really glad that's the way it fell. But I want to get started by steps to financial success. You want to start with where you're at today, and that's why I mentioned that. What does my monthly expenses look like? What does my budget look like? What does my emergency cash flow look like? I always try to tell people, the biggest thing you want to focus on when it comes to emergency cash is having 3 to 6 months to live. When we get to that point, if I'm confident and you're confident in that, hey, if the car breaks down, if a medical emergency happens, if something like that happens, I'm good there. I want you to be able to have that peace of mind. So where are you today? That's where we always start looking at. And then we kind of get into the investing piece. So where would you like to be? I know you talked about retirement on Tuesday, I believe. That right, Kaysie? That's a big thing on the front of people's mind when it comes to investing, because whether you have a 401k at work, whether you have thought about starting a retirement account, it often comes to mind of where would you like to be. I don't know where you're at in life, if you're on this call, or how far maybe you're away from retirement, or maybe it's a shorter term financial goal, but where would you like to be? That's a hard question to think about sometimes, but that's where we like to start when it comes to investing, because then we kind of look at, what can I get there? How do I get there? Because the number one thing about investing is this: you want to develop a strategy. The secret to investing, is not in any sense of timing the market. It's time in the market. That's the secret to it. And the way we get there is we develop a strategy. So you have to be able to do that, to show yourself and to work, say, hey, can I get there? Because that leads to the how do I get there, and then how do I stay on track? That's why it's so crucial to develop that strategy, not only for the short term, the budgeting needs that you need for every month, the emergency cash needs that you need, and in the long term, how do I save for the future? How do I get there? how do I stay on track? So if you remember anything I was say today, when it comes to investing, it's developing a strategy and putting that and sticking with it. Because the why leads to the how. Why do we invest? You know, somebody answer me in the, if you're following along, can you answer me in the chat? Why do we invest? Am I got an answer? Okay, extra income, make the most of our money, hopefully grow what we have. I like these answers. Maximize money potential, yeah. Increase assets. It's good. These are good answers. But I want you to, they're all stemming from the fact that, hey, we know that we need to save for the future. And we know that we need to grow our money, whether it be through working hard and hopefully getting raises as we continue to work, but then also growing and saving for another day. But you want to have a how behind that, and that's what I help people try to discern of, hey, if it's retirement, when do I want to retire? How do I want to retire? Because the how is really important along with the when. Okay. And that's why it's important to, again, develop that strategy, to know and to set your goals. Be realistic with your goals. So kind of on the strategy piece, has anybody ever, I don't know if you've seen this much when it comes to investing, but this is kind of what I break it down for people when it comes to how do you allocate your investments. And how you allocate your investments depends a lot on how you feel about and your comfort level when it comes to market fluctuations. We know that the stock market, that it is going to fluctuate. It is a fact of life. We know it's going to change on a dime. A little real-time, example of that is end of 2023, the stock market was on a rocket, a rocket ride, and things were going really well. Federal Reserve came out on Halloween of this past year and said that, hey, we feel like maybe inflation's at a point now where we can cut interest rates in 2024. Well, it responded well to that. Things were going well. All of a sudden, yesterday we get a hot inflation report. Manufacturing came a little bit high. People were still spending money. There was no need for prices to be cut yet, and so now it's a little bit of an if and when our interest rate is going to be cut, and so, because of these things that happen, the market fluctuates. It's going to do that. And so what you want to be properly allocated, and that goes a lot of that strategy I'm talking about is a huge factor in that. This right here is kind of a breakdown of what you usually see in a portfolio that I would build in a brokerage account or an individual retirement account. And you'd probably see similar in if you have a 401k or 403b or whatever. If you have a retirement plan, you probably see similar. And what you're seeing is you are properly diversified across the board based off how you feel about and your comfort level with risk. So let's just say you're usually what I like to say is you're a category 1 and between category 1 and category 5 investor. Category 1 being, I don't want it to fluctuate and I don't care how much it grows, but I just don't want it to fluctuate. Category 5 being, I want it to grow. I know it's going to fluctuate a lot, but I want it to grow. I want to buy growth investments. Where you're at is dependent on how you feel about it, number one. But two, what is your time horizon? What are you trying to save and invest for? Because again, the value of the market is the time in it. It's not the timing of it, it's the time in it. It's the consistent strategy and being diligent with how you save and how you invest. And so this pyramid right here kind of shows a breakdown of a portfolio allocation. So what that means is if you, let's just say you were growth minded, you were category 4, category 5 investor, you would be around 80% stocks and 20% bonds. 80% stocks being 80% growth focused investments. That large cap and small and mid cap are stocks that are growth oriented. So large cap stocks, sure most of you have heard of the S&P 500 or the Dow Jones. These are companies that are growing in a fast manner, that are growth oriented. Okay, small and mid cap companies. I always like using an example. Think about Tesla 12 to 13 years ago. At that time, Tesla would have been considered a small to medium sized company. It's now a large company, obviously, but these are companies that have potential to grow. But this is why it's important to have you be properly balanced, because what happened when the Federal Reserve said that on Halloween was the index that ticked the highest in November and December of 2023 was the Russell 2000. The Russell 2000 is an expansion on the S&P 500, the Dow Jones. It has more smaller, medium-sized companies. What happens when interest rates are cut? Business is a little bit easier to do for those smaller, medium-sized companies, as opposed to the large companies, which can have heavy reserves, lots of investors, lots of shareholders, and they can stomach high inflation a little more. So that's why it's important to be properly balanced, because you don't know when the market's going to change in different directions. The same can be said for income and bonds. One of the things that a lot of investors have flocked to since interest rates have gone so high are certificates of deposit. CDs have been trailing around 5% since the middle part of 2022, and they've been a good investment to buy. They're federally insured, and it's hard to turn down 5% federally insured, guaranteed what you're going to get. At the time of 2022, with inflation running so high, it was important to be properly allocated. And the same can be said for now, as inflation maybe starts to cool a little bit. A good example of this is, and one philosophy of investing that I would want you guys to take today is buy low, sell high. You're going to get, if you're able to buy things when they're lower and sell them when they're higher, your investments are going to be a little bit cheaper when you buy them, and you're going to be able to turn a little more profit when you sell them at a higher price. So bonds have trailed a little bit behind the stock market. Well, what happens when the interest rates go down? There's an inverse relationship between the price of bonds and interest rates. So as interest rates are eventually cut, the bonds will go up. It's an inverse relationship. So now would be a good time to buy bonds, because bonds are lower. And once those interest rates are cut, if you're holding those bonds, they're going to be taken a little bit higher because those interest rates are falling. So it's important to develop a strategy and stick with it and have it in place, because the market's going to change. It's going to change. Rule of thumb on the stock market, for every 3 years it's up, it's down 1. It usually works in those 4-year cycles. And so you want to be able to be sure that you have a strategy in place. You weather the storm. A lot of investing is a mental game, to be able to weather the storm and be patient and know that the market's going to change, and make sure to not overreact to a little bit of corrections. Like we had yesterday is a good example with a heavy inflation report. Stocks didn't respond well to it, but there's no point in changing a long-term strategy just based off one day of a bad market. It's a long-term game and a long-term strategy. So can anybody tell me, has anybody heard the term bull and bear market? You can just do a thumbs up, react on Zoom, or say yes in the chat. Anybody ever heard of bull and bear market? You've probably seen pictures of Wall Street with the bull outside, right? Yeah. Somebody's heard of it. Well, that's kind of what I'm talking about when I say for every 3 years it's up, it's down 1. That market cycles. 2022 was a pretty large bear market. As a good example, more recently, inflation went really high. A lot of people got stimulus checks from COVID. A lot of people were working from home now, and so maybe your expenses were lower, so people had a lot of money to spend. Prices started getting higher, but people still had the money to spend, and people kept spending it. Hence, inflation went higher. Market didn't react too well to that. It works in those cycles, right? we've since come out of that, and now we're in for what a lot of people think is a bull market. People are optimistic. Okay, there's reason to be. Even with inflation still being high, interest rates still being high, the stock market has had a really good year, even despite all that. And so you're going to see those come in cycles, right? But like I said earlier, if we put our strategy in place and stick with it, we see success on the backside of it. We do. There's clients that have been in our branch for almost 30 years that have weathered a number of different storms, including 2008, and the financial crisis then, the tech bubble in 2000. They've seen a lot of change. They've seen a lot of bear markets, but they've stayed invested, they've stayed diligent with it, just as we do in our normal monthly budgets when it comes to saving, when it comes to budgeting, and they've stuck with it, and they've seen success on the other side of things. And so just know there's going to be bull markets and there's going to be bear markets. It's a long-term strategy in place. That's the most important thing when it comes to investing in anything, whether it be for retirement, shorter term, whatever that may be. All right. When it comes to stocks, right? And this is, and I mentioned this earlier, you want to buy low and sell high. Okay. You can see this breakdown right here, right? And so this is kind of what we're going for when it comes to stocks. Let's just say you bought a stock 3 years ago, right? And then you got another stock and you bought it a year ago. You purchased it for $20. What you're wanting to see out of that stock is a bit of capital appreciation, like you're seeing here. You want to be able to buy it for $20 and turn around and sell it for $30. Okay, you don't want to buy it for $20, only hold it for a year, and maybe it trades flat, and maybe you're selling it for what you bought it for, or maybe it falls a little bit. Okay, now there's no holding it from 1 year to 3 years. There's no guarantee that it's going to turn that, in this case, the $10 profit. But it's important that when we're thinking about growth investments, that we allow them to grow. Okay, growth investments can fluctuate a little more, especially more than fixed income and things that are steadier. But they're going to provide us this potential of return if we stick with them. Okay, make the necessary changes when you need to, but stick with them. Okay, because you want to be able to, again, buy it when it's low. In this case, you bought a stock for, say it was $20. You turn around and sell it for $30. You turn a $10 profit. Okay, you bought when it was low and you sold when it was high. Okay, that was, in this case, it was a sound investment move that you made. Okay, buy what's low, sell what's high. You remember the first five, couple steps back here. It was develop a strategy, stick with quality, and diversify. Okay. When I say diversify and you stick with quality, you want to have investments that offer you a chance for some what's called rising income. Rising income investments are investments that have the potential to keep increasing their dividend. Has anybody heard of a dividend and what it means? Anybody want to say it out loud? Put it in the chat if you've heard what a dividend is. A dividend is a set amount that can change, that can grow, that usually rises, that a company that you own is going to, or a fund that you own is going to pay every so often. And there's certain companies that fall in that rising income, rising dividend category, to where these companies are growth oriented, that are going to not only provide you a certain growth, a growth potential that will vary, but is also going to provide you a dividend every so often. A quality investment. And that's important in terms of your long-term strategy when it comes to investing, is the quality of what you're buying. You want to be able to balance that out with some dividend paying stocks in this case. It has the potential to help offset inflation. Is a big reason why. I mentioned 2022 being a bad year. Stock market fell in a lot of portfolios around 14 to 15% that year. So what, again, long-term strategy, don't change too much, but change when you need to. A lot of the changes that were made were shifting to dividend paying stocks. Well, stock market was down, but what are those stocks still doing every so often? They're still paying the dividend. So even if the normal trading, the normal growth that you're, growing at is falling a little bit, it's still quality investment, because even in the bear market, even in the downtimes, you're still getting a dividend off of that. You're still growing, and getting that little bit of income. Can also provide quarterly or monthly income, and it just increases your total return potential. So it's important to own these high quality dividend growing stocks and mutual funds and ETFs. When I mentioned mutual funds and ETFs, these are what we would call a packaged investment product. A mutual fund is, and if you have a 401k, if you have a 403b, odds are you are in mutual funds, or you are what's called a target date fund. And what that means is you own an investment that has hundreds of different investments inside the fund, and someone somewhere is managing that fund. And what they're doing is they are reallocating the fund based off of your time horizon, your comfort with risk, and how you want to be allocated, how you want your strategy to go for yourself. So there's 3 different strategies here when it comes to these packaged products, and that's growth, income, and growth and income. Growth, as you can imagine, is mostly stocks. Income is fixed income, bonds, steadier products, and then growth as income is right in the middle. And you're buying these funds, you're buying these packaged products, again, based off your time horizon, based off of how long you have to invest. Let's just say you bought, you have a 401k at work, or 403b, or whatever it may be, and you are wanting to retire 2045. You might have a fund inside your workplace retirement plan that is listed as target date fund of 2045. So what that's doing is, when you sign up for that, you are investing based off your time horizon. So that's about 21 years. So you're still, that would still be considered growth mode. So you would still fall in that growth category of where you're in a fund that is buying heavier on growth investments, that is tilting you towards that direction, all while being managed and being reallocated properly, as the market changes. So they're really valuable because they allow you to own different investments and allow you to track with how the market's doing. Because you can earn multiple companies and diversify. That's what's important. When it comes to investing, you want to be able, number one, you want to be diversified. You want to make sure that at the end of the day, your money isn't disrespected with the market. A great way to do that is to have these mutual funds and ETFs that provide multiple companies to be invested in. It allows you to have growth-oriented companies, value-oriented companies, maybe bonds. It allows you to diversify across the board properly, without having to buy and own so many different individual securities. And so they're really crucial. The difference between the two of them is mutual funds are more actively managed. They are usually have a fund manager who had, on a day-to-day basis, is looking at the fund, is changing allocations, and is working for you, and when it comes to managing that fund. ETFs are more passively managed. So an ETF that I use a lot tracks the S&P 500. So let's just say you have this fund, you had the fund in your portfolio, you had in your investment portfolio. A good way to follow that is, and I know if you have an iPhone, is to plug that fund in to your stocks app. It comes immediately when we get the iPhone. and you can follow it, and it tracks the S&P 500. So the S&P 500 gained 1.5% on the week, then you probably have a good sense of, hey, this fund is tracking along, pretty well with what the S&P 500 is doing, almost just about mirroring it. And so there's a difference between actively and passively managed funds. And one of the difference in the two, because being actively managed and being passively managed, mutual funds do pay out sometimes what is called capital gains. And those are, and this is every year, because if your mutual fund has grown, it's, because the fund manager is changing things around a lot, you're going to have to pay a little bit of capital gains distributions back. So it's nice to have a little bit of a mixture of both, because ETFs, because they're passively managed, are more tax efficient for you. So it's good to have a mixture of both, because it goes hand in hand with the diversification that I was talking about earlier when it came to stocks and bonds. You want to have a diversification of different tax efficient investments too. For the most part in your workplace plans, you're not going to hold too many investments in a retirement account, because the IRS has certain stipulations in place on what type of retirement account you have and what tax what tax laws are for it. Then it is not a big of a deal. But if you invest outside of those workplace plans, outside of those retirement plans, it's important to have investments that are a little more that balance each other out. Mutual funds can often, because they're actively managed, could possibly provide a little bit better return, but you're going to have a little more tax efficiency with your ETFs. And so you want to make sure to have both, and you want to make sure that you're properly diversified, because that's what's important for your long-term investment strategy to work. Two, you want to, again, the rising income I mentioned earlier. Bonds are important because you get some annual interest off of it, stock dividends, and then of course share price increase as well. Again, diversify. It's crucial and important to reaching your long-term investment goals. And I mentioned it earlier, it is vital really to invest for the long term. And this chart right here kind of shows you the difference in what a lump sum investment looks like and what a systematic investment can look like. In your workplace plans, if you have one of those, a 401k or a 403b, most of the time you are investing systematically. Every single month if your company provides it, you are either taking some out of your check and your company is matching, or maybe they don't provide a match and you're just doing it, but you're systematically putting into that every single month. So every single month there's a little bit that's going into there. And what that's doing is doing a thing called dollar cost averaging. So let's say, in this case, you're putting in $417 a month into your whatever it may be, whatever account you're putting it into. What that's doing is it is buying what's low and selling what's high. So a good example in accounts that we've got here at Edward Jones, if you're putting $417 a month into an account that I would manage, we have, whether it be me doing it, whether we one of our accounts doing it, where it knows automatically every single month to buy what's low and sell what's high. So if you're seeing this, you're looking, if you did 1 month sum of 5,000, as opposed to doing this dollar cost averaging every month, the dollar cost averaging is saving you about $3 a share, and you're getting 50 more shares, because what's the market going to do? It's going to change. Okay, it's going to fluctuate. So what that's allowing is every single month when you're putting that money in, you are able to find investments that have maybe a little bit lower price. Maybe it was a Walmart. Maybe you own Walmart in your portfolio, and Walmart traded a little bit lower in the month of February, and it was $17 a share. Maybe March happens, they get a good earnings report from the last quarter of the year, and then all of a sudden their shares up to $20. So your dollar cost averaging helps you in the long run because you're saving a little bit of money when it comes to investing, because you have more opportunities to buy what's low and sell what's high. It's a system to it, and that's why the long term helps, because stocks are going to do this. They're going to fluctuate. That we know that. We want to find those opportunities to buy them when they're at their lowest. Anybody who's invested much recently or invested some, by show of hands, has anyone heard of NVIDIA? You can do a thumbs up. If you're into stocks, really, if you've heard of it. Anybody heard of NVIDIA? Okay. Well, NVIDIA has been the real big winner of the stock market over the last, I would say, 12 to 18 months. And last time I checked, it was trading at around in the $800 a share region. Well, while it's been a big winner, been a big bell cow, it's at its most expensive to buy, right? And so it's one of those things you got to think about. We love when stocks go up, but it makes it a little harder when they go up to buy. So we want to be able to have opportunities to buy when we're low and sell when we're high, because it helps us in the long run. Saves us a little money. In this scenario, you're buying for $17 as opposed to $20 a share, and you're getting more shares as well. So you're having more opportunities because you have more shares to get some more growth down the road. And so it's important to have, again, the strategy piece is vitally important. It is. And when it comes to investing, the last thing I really, the big thing you want to hit on when it comes to investing is focusing on what you can control. I mentioned it earlier. I'll show you that wheel. It's a really good way to think about your finances. But what you can control and what you need to control is the first thing is, where do I start? And so that's why I told you, I'm glad this fell the way it did, because your saving and spending habits comes first. It does, because the most important thing is you need money to live off of every single month. You need to have an emergency fund, and you need to make sure your debt's in control. If you let your debt get out of control, if your spending habits are a little bit outside your means, if you don't have an emergency fund built up, then it's really hard to develop an investment strategy and keep it going for the long term, because you're struggling to short term a little bit. Okay. And so I tell people all the time, I don't want you to mortgage your present just for your future. Okay. I want you to be able to, in the meantime, live the way you want to now, but then live the way you would like to later too. And a huge help in that is, number one, controlling what you can control. Okay. We can't always control the market. We can't do it. It changes on a dime. We get bad inflation reports like we got yesterday. We get, decent inflation reports like we got in November, and it took since start mark on a high. We can't control that. Okay. We can't control our saving and spending habits, emergency fund, and your level of debt. Same as we can't control tax laws and investments risk. Okay. Those things are going to change. Okay. They're going to change, and constantly change. Okay. We again, that's why we develop a strategy, so we can weather those changes. But we can't do that. We can't control it. And so control what you control, focus on that. And that's a real important thing. When it comes to investing, is starting where you can start and doing what you can do first, and controlling what you can control. All right, I wanted to open it up for questions too, and just if you have anything for me, when it comes to investing, if you have a workplace plan, but is there any questions for me? Have I got any questions?
All right. Well, thank you, Jonathan. If anybody has any more questions, you can throw them in the chat. But I think Jonathan's got his info there too, if you'd like to take a picture of that or screenshot your screen. Oh, we did have one question. Do you have any experience with programs like Robinhood?
Yeah, so that is it's a little different than Robinhood allows you do what's referred to as day trading. And day trading is it's a little more. I'm gonna say this. It's a little more labor intensive. It's a lot more labor intensive. It allows you to do it yourself too. What I tell people, I tell people all the time is if people who work with me, clients of mine, I'm happy that you have a Robinhood account or an E-Trade account or things like that, because it helps us work together better if you're able to understand it. And so about, what I would say to this is develop a strategy, whether if you're working with a financial advisor like myself or you're doing it yourself, it is important to develop strategy. Just be wary of day trading a bit, because it can throw your brain for a loop. I can say that because it just changes so much. It just changes so much, and it's a little bit harder to react to. A good. I'm glad I had yesterday an example to share with you all, because not many people knew what the inflation report was going to read yesterday. Came in hot, and market reacted pretty negatively to that, and so it they're good to have, I would say, because it helps you understand it more. But just make sure if you have it that you have a strategy in place to do that, because it can get, it's a lot to handle, especially if we're doing it on a day-to-day basis. And don't watch too much television. That's especially in the year that we are in. Try not to watch too much television. There's some good information out there, but read, talk to people you trust, and that's the most important thing. It's just don't watch too much television. I can't stress that enough. Put Netflix on or something else. So.
I hope that you enjoyed today's presentation. If you have any questions or comments related to the topic, please don't hesitate to contact our office at 865-453-3695. And remember, we're better together. Have a great day. Bye.